Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back, and it's about 2 minutes to the start of India's trading day. Looks like Nifty futures under some pressure, in line with the rest of the region. Now, India's bilateral trade with China rose by 1/3 in the year to March, a setback for Prime Minister Modi's drive to wean the country of cheap imports and promote a thriving domestic industry. Let's discuss this with Madhavi Arora, lead economist at Emkay Global. Madhavi, good to have you with us. I mean, as much as Modi wants to wean the country of China's imports, it gets addicted to cheap products at a time when inflation is a problem.
So I think clearly, I think one thing that I had highlighted last time as well, with regard to how, while trade deficit remains a worry for India, I think the bilateral trade with China is something that is a bigger worry. This year has been pretty decent for the rupee in general, except for the last couple of weeks. And more importantly, against China, we had appreciated close to around 5-6% until very recently. And we run almost 40% of our bilateral trade deficit with China. So clearly, this somehow, made me feel a little uncomfortable with the so-called rupee appreciation against its emerging peers, even though it was going down against the dollar. I think that is one worry that Modi has to take care of as we go ahead, because there could be a possibility that India could continue to remain an outlier in the emerging market space, unless, of course, managed by policy intervention.
We're seeing slowing exports, Madhavi. I mean, how will that impact India's growth projection, perhaps through the year and 2023?
So I think exports was a big lever last year, last 2 years actually. India did really well. I think most of the Asian countries did very well on exports, partly on account of the fact that the world was deficient in goods, and whichever country was able to supply goods, did really well. So India's engineering goods particularly did really well in terms of export trajectory. Of course, they are linked to how global demand really pans out. Clearly, we are seeing signs of a slowdown, which could actually lead to a recession in the developed world as we go ahead in 2023. I think that clearly would pressure on exports on a downside, and we could see a contraction, a deep contraction in export as we go ahead into next year. And that's one lever of India's growth that was sort of shining last 1.5 years, would again look to be a little weak for me, and thus I'll again struggle to look for any sustainable or a secular economic agent which could actually run India's growth story to a 7+ kind of a trajectory.
Madhavi, this is David. Does that also mean, and I'll tie this to the inflation story and what the RBI does, is that enough to slow down core inflation persistence?
See, to some extent, India's core inflation generally, has always had a very sticky component to it. It tends to stay at a certain range for a long period, and then suddenly it goes either up or down, and again remain in a sticky range. I still don't think that India has a wage price spiral problem. I think if I look at the rural wages, they have been on a real basis largely in the range of +2% to -2%. And as well as the urban employment, which has been resilient over the last 1 year or so, looks to be now fading to some extent. And I think to that level, my sense is that the wage price spiral, which actually feeds into domestic demand and core inflation, is not as strong. And more importantly, we will be, at least in the next 6 months or so, we'll be seeing some correction in global production prices or input prices, which could also percolate down to core inflation. And we should be able to see core inflation coming off next year. But of course, it's going to be a struggle, as everybody else in the world is right now facing. But that said, my sense is that RBI at this point in time is still not getting too restrictive on policy rates, and thus there is scope for them to go ahead and raise rates further, essentially to tame down core inflation, which to them is now becoming a worry.
Okay, and at some point, let me know if it's too early to talk about rate cuts out of the RBI. As you mentioned, we're not restrictive just yet. The RBI doesn't tend to sit on rates between cycles too long. Do you think we'll find ourselves in a situation where this time next year rates will actually be lower for the RBI than they are currently?
I think no central bank at this point in time wants to give any commitment on that front, and RBI is no different on that level as well. So look at the Fed. At this point in time, they are still talking about looking for more evidence as far as inflation sustained downward trajectory is concerned. RBI is no different. I think I'm not looking at the Reserve Bank reversing its course, at least in the next 1 year or so. But I think a lot of it will depend on how global situation pans out, because the world is moving at a very fast pace. One still doesn't know, how fast the core inflation will decelerate, how bad the sacrifice ratios of output is going to be globally and back home. And, you don't really know as to where and how long the Fed would continue to keep its policy rate at a very high terminal rate of 5 to 5.25%. So I think a lot would depend on the global reaction function of central banks. But as of now, I think RBI still has more room to hike, though not to get too restrictive, but will probably stay at a 6.5 kind of policy rate for at least 1 year from now.